Welcome to the deep dive. Today, we're jumping right in, aiming to cut through all the noise around Bitcoin and open blockchains. We want to give you a real shortcut to being genuinely well-informed, especially thinking about where things stand now, heading into 2025. And really, this isn't just about the tech specs. It's more about understanding a pretty profound shift, actually. A shift in how we even think about digital value, digital trust.
Absolutely. And our goal today is just clarity, pure and simple. We'll kick off with the core problem Bitcoin actually solved, that whole double spending thing. Then we'll get into the 6 pillars, the things that really make an open system open. We'll look at the blockchain trilemma, those trade-offs. And then Bitcoin's real competition. It might not be what you think. Finally, we'll sort of differentiate Bitcoin from things like tokenization, stablecoins. You hear about those a lot. They're useful, for sure, but they don't really play by the same rules. So whether you're deep in the tech weeds or just curious, this should give you a solid foundation.
Okay, let's start there then. The original problem, double spending. Before Bitcoin came along, digital money had this massive flaw. What exactly was the double spending problem?
Right. So imagine you have, like, a digital file representing $1. What stops you from just copying that file, hitting Ctrl+C, Ctrl+V, and then spending both the original and the copy? In the physical world, you can't do that with a dollar bill, obviously. It's only in one place. But digital stuff, easy to copy. That was the fundamental challenge. How do you make digital value unique and uncopyable?
And traditional finance, how did they handle this? Because we do use digital money.
Yeah, they handled it with central authorities, basically middlemen, think banks, Visa, PayPal, whoever. They keep the main ledger. They're the ones saying, okay, this digital dollar moved from A to B, and A doesn't have it anymore. But that means you have to trust them. Trust they won't mess up the records. Trust they'll stay online. Trust they'll be fair. It all hinges on trust in that central party.
Okay, so banks were the trusted scorekeepers. Then along comes Satoshi Nakamoto in 2008. How did Bitcoin get around needing that trusted middleman? What was the big idea?
This is where it gets really clever. Satoshi's breakthrough was creating a ledger, but making it public, decentralized, and time-stamped. So instead of one bank holding the records, you have this global network of computers, nodes, all holding a copy of the same ledger. And they all work together to validate transactions using this process called proof of work. It's computationally intensive, requires real energy. That work is what secures the network. It means no single entity is in charge, no gatekeepers, no backdoors, and crucially, no way to double spend because everyone is watching and the math enforces the rules. It's kind of like this giant shared public spreadsheet that anyone can see, but nobody can tamper with once something's written down.
That visual helps. A public spreadsheet everyone watches. But we hear blockchain everywhere now. Are all these other blockchains doing the same thing? No central control.
That's a really key distinction. No, they're often not. What you frequently see are permissioned or private blockchains, maybe run by a company or a group of companies, maybe even a government. And because they aren't fully decentralized like Bitcoin, they could potentially be altered, rewritten, or censored. There's still someone or some group ultimately in charge. So you could say Bitcoin solved the core trust problem. Many others just put a tech bandage on it, often reintroducing centralization in a new guise.
Right, so it seems Bitcoin's approach is more philosophical almost, not just code. You mentioned these 6 pillars like the soul of Bitcoin. What are they? What makes it truly open?
Exactly. These pillars define what an open blockchain is, using Bitcoin as the benchmark.
Right.
Okay, first, permissionless. Anyone can join the network, send transactions, run a node, no ID checks, no KYC like your bank demands. Just need internet access.
So totally open entry. Got it.
Second, open source. All of Bitcoin's code is public. Anyone can read it, check it for bugs, suggest improvements, even copy it to build something else. Total transparency.
Nothing hidden.
Third, borderless. It just works everywhere. Doesn't matter if you're in Dubai, Lagos, London, anywhere. No cross-border friction like with traditional money.
Truly global.
Fourth, censorship resistant. This is huge. Once your transaction is confirmed by the network, nobody, no government, no company, no powerful individual can block it or reverse it. It's set in stone.
Wow. Okay, so unstoppable transactions.
Pretty much. Fifth, neutral. The network treats all transactions and users the same. The rules apply equally to everyone. No VIP fast lanes, no special treatment based on who you are.
Level playing field.
And finally, sixth,
Yeah.
publicly verifiable. Every single transaction, right back to the very first one, is recorded on the blockchain for anyone to see and verify. You don't need to trust an auditor. You can literally check the entire history yourself.
Okay, those six together: permissionless, open source, borderless, censorship resistant, neutral, publicly verifiable, that paints a very different picture from, well, almost everything else. What's the big takeaway here for someone trying to understand Bitcoin's place in the world?
The takeaway is that this combination is incredibly rare and incredibly valuable. It's these principles, these values embedded in the system that truly define Bitcoin. More so than just the underlying tech itself, it's a commitment to openness and resilience.
Right. But like any system, especially something this ambitious, there must be trade-offs, right? This brings us to something called the blockchain trilemma. What's that about?
Yeah, the trilemma. It's this widely discussed idea that it's really hard, maybe impossible, for a blockchain to simultaneously be perfectly scalable, perfectly secure, and perfectly decentralized. You often have to prioritize two out of the three or make compromises.
And where does Bitcoin land on that? Because you do hear people talk about Bitcoin transaction speeds sometimes.
Bitcoin makes a very clear choice. It prioritizes security and decentralization above all else. The trade-off is scalability, or raw transaction speed on the main layer. Yes, Bitcoin transactions can be slower than, say, a credit card swipe, but that's a deliberate design decision. That focus makes it incredibly robust, secure, and resistant to capture or control. It's built like a fortress, prioritizing safety over speed.
Okay, that makes sense. It's a conscious choice for resilience. But then you see all these other crypto projects popping up, often advertising much faster speeds. Aren't they just giving the market what it wants, faster transactions?
It seems that way on the surface, doesn't it? Many newer projects do optimize heavily for speed and throughput. But here's the crucial bit. How do they achieve that speed? Often it's by cutting corners on decentralization. They might rely on a much smaller number of powerful validators, or use more centralized infrastructure, or have some kind of corporate entity overseeing things. So you get speed, but you sacrifice genuine decentralization and censorship resistance. We sometimes call it tech-wash centralization. Looks like a blockchain, but still has central points of control. Bitcoin's view is that if you compromise on decentralization or security, you fundamentally break the core promise of a trustless system.
Okay, this next point might be a bit controversial, or at least not what you hear every day in the crypto chatter. You're saying Bitcoin doesn't really compete with things like Ethereum or Solana or Dogecoin even. That seems counterintuitive. So what is its real competition?
Right. And this is key to understanding Bitcoin's purpose. Its true competition isn't other cryptocurrencies. Bitcoin's primary competitor is the existing global financial system, specifically state-controlled fiat money, like the US dollar. It's aiming to be a fundamentally different type of money. Think about it. The US dollar is inflationary by design. Its supply increases over time. Bitcoin is mathematically deflationary, capped forever at 21 million coins. The dollar is issued by a central authority, the Federal Reserve. Bitcoin is issued through mining, a decentralized process based on math. The dollar's rules can be changed by committees and governments. Bitcoin's rules are governed by its code and the consensus of its global network. It's a completely different paradigm for money.
So Bitcoin is positioned against fiat currency itself. Then what about all those other cryptos? What's their game?
Most other projects in the crypto space are playing a different game. They're generally trying to add more features. Faster payments, yes, but also things like smart contracts, decentralized applications, dApps, different consensus mechanisms. They're building platforms for various Web3 applications, essentially.
But is there a downside to chasing all those features?
The potential downside, or at least the difference in philosophy, is that many are chasing features, not fundamentals. You could say they're trying to build apps, whereas Bitcoin is focused purely on being money, incorruptible, decentralized digital money. Bitcoin's strength is its simplicity and its unwavering focus on that one core goal. It doesn't try to be everything to everyone.
Okay, let's shift gears slightly to something really hot right now. Tokenization and stablecoins. We're seeing stocks, bonds, real estate potentially being put on chain as tokens. Central banks are looking at CBDCs. And stablecoins like Tether, USDT, or USD Coin, USDC, are huge, driving DeFi and payments. They seem fast and efficient.
They are undeniably useful tools and often very efficient. But, and this is a big but, we need to be crystal clear, these systems are generally not open in the same way Bitcoin is. They operate under very different principles. Let's quickly run them through those 6 pillars we talked about earlier. Open source, Bitcoin, always. Tokenization platforms, sometimes. Stablecoins. Rarely fully open, you often trust the issuer's reserves.
Okay.
Permissionless, Bitcoin, absolutely, 100%. Tokenization. No, you need an issuer to create the token and often permission to hold it. Stablecoins. Definitely not. Issuers can freeze or blacklist addresses.
Right, you hear about stablecoin addresses being frozen?
Exactly.
Yeah.
Borderless. Bitcoin. Yes, truly global.
Yeah.
Tokenization, often restricted by jurisdiction depending on the asset. Stablecoins, subject to regulation and issuer limitations.
Makes sense.
Censorship resistant. Bitcoin, highly resistant, practically immutable once confirmed. Tokenization. Tokens can often be frozen or revoked by the issuer. Stablecoins, frequently censored. Issuers comply with government requests.
Big difference there.
Huge. Neutral. Bitcoin. Yes, rules apply equally. Tokenization. Controlled by the issuing institution and their rules.
Yeah.
Stablecoins. Controlled by the corporate issuer and their policies.
It's not neutral then.
Not really. And finally, publicly verifiable. Bitcoin. Yes, full ledger audit possible by anyone. Tokenization often relies on opaque off-chain verification of assets. Stablecoins. You have to trust the issuer's attestations about their reserves.
So putting it all together, what should you, our listener, take away from this comparison with tokenization and stablecoins?
The main thing is, while tokenization and stablecoins leverage blockchain tech and offer real utility, they don't share Bitcoin's core commitment to openness, neutrality, and censorship resistance. They typically involve central points of control and trust. So they aren't really liberating systems in the same vein. They're useful tools, yes, but fundamentally different beasts built on different trust models.
Okay, so let's wrap up this deep dive. We've covered how Bitcoin tackled the double spending problem with its decentralized ledger, how it made that conscious choice, prioritizing decentralization and security, even if it meant sacrificing some speed on the base layer. And those 6 pillars, permissionless, open source, borderless, censorship-resistant, neutral, publicly verifiable, defining its core identity. Crucially, it doesn't ask you to trust it, it invites you to verify.
Precisely. And as we see so many other digital assets and projects rushing to add features, competing to be the next big platform, Bitcoin just keeps doing its thing. It continues this kind of quiet rebellion against the traditional financial system, against fiat currency itself. Its unwavering adherence to those foundational principles, that extreme focus on decentralization and security, makes it arguably more relevant today than ever, especially in a world that's frankly full of digital noise and systems demanding your trust. So maybe the final thought to leave you with is this. In an age of complexity and control, what does a truly open, truly liberating digital system look like? And why might Bitcoin's stubborn, principled design be so uniquely powerful in answering that question?